Good morning, everyone, and welcome to the IPO Readiness for Energy Companies webinar presented by Hein and Associates and Thompson and Knight. I'm Carrie Baynes, your moderator and webinar organizer today. Before we start, let's take a moment to cover a few housekeeping items. All audio lines are muted. Please use our chat feature to ask questions. We will save time at the end for Q&A. This event is being recorded, and a link to the recording will be sent out to all registrants later today. Your active participation is important throughout the session. In order to receive CPE credit for this session, you will need to be connected for a minimum of 50 minutes and must answer 75% of the polling questions included throughout the presentation. Immediately following this webinar, you will be directed to a survey page where you can leave comments. Please check your inbox later today for a follow-up email that contains an evaluation form that must be submitted in order to receive your CPE certificate for the course, a link to the webinar recording, and presentation materials. Our presenters today are Wes Williams, Lori Mathiel, and Joe Blythe. Wes Williams is the firm-wide corporate and securities practice leader at Thompson Knight. He provides legal counsel relating to mergers and acquisitions of public and private acquirers and targets, and strategic relationships such as joint ventures and corporate partnerships. Additionally, he counsels public companies in connection with corporate governance, SEC reporting, and general securities compliance. His accolades include being named to the Best Lawyers in America in Corporate Law and Texas Super Lawyers in Securities and Corporate Finance. Lori joined Hein and Associates in 2006. She specializes in business taxation, including both corporations and partnerships. Specifically, she focuses in areas unique to private equity investments, including maintenance of IRC Section 704B capital accounts, targeted capital computations, and IRC Section 704C considerations. Lori has an additional focus in ASC 740 accounting for income taxes. She serves clients in a variety of industries, but her main focus is energy and manufacturing and distribution. Joe has served as an audit partner since 2007 and has been in the Dallas office of Hein and Associates since 2003. He provides a wide range of audit and accounting services for both public and privately held companies in the energy industry. Joe serves as the National Energy Practice Area Leader and is a member of the Council of Petroleum Accountant Societies, where he has served in various capacities since 2003. He also serves on the conference committee of the North American Petroleum Accounting Conference and is a frequent speaker at various energy-related presentations. Thank you for attending today, and I would now like to introduce Wes Williams.
Thank you very much. I got to really question the collective wisdom of this group in allowing the lawyer to speak first, because two things are going to happen here. One is I'm going to go over time and cut into the really important stuff that you want to hear about, and two, your audience will be asleep by the time the second two speakers get to go. Nonetheless, I've been asked to give you the high-level legal considerations when preparing for an IPO. There are a lot of things that you can imagine go into the IPO process, and hitting all those in a 15 to 18-minute segment is a bit of a tall order. So we're going to go pretty quickly today, and we're going to move to our first slide where we talk about the overall process. After we talk about process, we're going to talk a little bit about emerging growth companies and the benefits of the Jobs Act, as well as some governance aspects of an IPO that you need to consider. So when you're going to take your company public, you're going to start with corporate housekeeping and the IPO prep, including selecting underwriters and assembling your IPO team. We're going to talk a little bit today about the quiet period, what it is, when it begins, when it ends. We're going to talk about holding your organizational meeting and who's going to be there. Underwriter due diligence, which really commences from the time you select your underwriter and runs all the way through the process until you close that IPO. And we'll talk about preparing and filing the Form S-1, which is the registration statement that you file with the SEC. It contains the prospectus describing the offering of securities that you're conducting in your IPO. once you file that registration statement with the SEC, there will be an SEC review and comment period. And that's an iterative process where you submit your filing to the SEC and they continue to comment on it to try to get it into full compliance with the SEC regs. Once you clear all those comments, you're free to commence your roadshow, execute and deliver your underwriting agreement, price your offering, and then close 3 days later. Next slide. Next, we're going to talk about the composition of your working group. The first thing you're going to want to do in an IPO is hire the team. There's likely to be a beauty contest for selection of the lead manager, but once you select that lead manager, the selection of the co-managers can happen anytime prior to the launching of the IPO. There will be various methods of selecting the co's. You're going to want to select issuers counsel, and the underwriters will select their counsel, and you're also going to want to engage your accountants who will help you with compiling the financial statements necessary to comply with the SEC regs. Once you assemble your internal team, you want to discuss the following things: the structure of the offering, the strategy that you're going to employ in deploying the offering, the timing and participants in the due diligence effort with respect to the company, and the team that you're going to put together to craft the disclosures associated with your registration statement and prospectus for your IPO. Next slide. That team is also going to want to discuss the structure of the offering. First, the size of the offering. Your underwriters will be able to provide you with a significant amount of guidance as to the appropriate size of the offering, depending on what your use of proceeds is, depending on how you want to go public, whether through primary or secondary components. Now, a primary offering is an offering where the company issues new shares in the IPO to the public stockholders. A secondary offering is if you have existing shareholders of the company that want to include their shares, whether through registration rights or otherwise, in that offering. Now, your underwriters are certainly going to have an opinion as to how many secondary shares could or should be included in that offering, and so you're going to want to consult with them and legal counsel regarding any secondary components to the offering. You're also going to discuss the number of authorized shares, because moving from a private company to a public company, you're likely to need a lot more shares, including blank check preferred stock if you don't have a larger number of common shares, and just other various and sundry classes of shares. Status of mezzanine financing, you just really kind of need to figure out if you have any of that, and if you do, what you're going to do with that in anticipation of your IPO. You're going to need to also look at your existing shareholder list to determine who your larger shareholders are and to determine whether there's going to be any additional disclosure that's going to be required with respect to those stockholders, or if they are going to have to file any Section 16 or Section 13 filings with the SEC independently. You're also going to want to think about lockup agreements, because your underwriters are going to want to lock up the directors, officers, and major stockholders for a period of time subsequent to the offering. And these are very customary and they're very boilerplate, but you just don't want to get caught flat-footed. You just need to understand and prepare for who will be subject to the lockup. You'll also talk to your underwriters about the distribution objectives and syndication of the offering, and you'll talk to them about a directed share program. And we often refer to that as a friends and family program, where you would take a certain subset of the shares that are being offered and direct them to a list of people selected by the company. Now, the underwriters are going to have a significant say-so in how large that is, and there's some additional disclosure that you need to put in your book, but you certainly need to address that early if that's something you want to do with your IPO. You're going to want to select a listing exchange, NASDAQ, NYSE. You're going to want to select your ticker symbol and get that reserved early in the process, and you're going to want to talk about the use of proceeds of the offering. Are you going to pay down debt? Are you going to use it for working capital? Are you going to use it for acquisitions? And so you just get that sorted out with your team early in the process, because it is a disclosure item. Other legal considerations are, when you're trying to get ready for your IPO, you want to identify the things that will impact your disclosure document, your prospectus, your risk factors, the things that you are required to disclose in the S-1 by the SEC. Those are going to include outstanding claims. Do you have any existing litigation? Is that ordinary course, or is that material to your company? Because that's going to impact how we disclose any potential liabilities in the book. You want to look at your loan agreement restrictions and other consents that you might need to offer shares. For instance, did you have preemptive rights for your corporation before you took it public? Do you need to get rid of those? Is there anything in your loan agreements that will prohibit you from doing this? I kind of categorize these more as foot fault items, but certainly something that you have to pay attention to because it can have bigger consequences. Blue sky issues relate to state securities laws. Since most listed companies are going to benefit from what we like to call the blue chip exemption, there's not a whole lot for the business people to focus on there with respect to the state securities laws issues. It's typically handled between issuers and underwriters counsel. Make sure that you have adequate board meetings to approve all the documentation that's going to be necessary in connection with going public. It's not just the registration statement. There will be any number of agreements to bless, new employment agreements, new benefit plans, those sorts of things. So make sure that you have adequate board meetings allotted. You want to think about your existing material agreements because you're going to have to disclose most of those with the SEC. You're actually going to have to file that document. So you're going to want to consult with legal counsel regarding any of those material agreements and ask your lawyer if there's any way that you could get any sensitive portions of those agreements treated confidentially by the SEC. There is a method of doing that. Can't mark the whole thing confidential, but there is a method to basically keep confidential any competitively sensitive information or other items similar to that. In addition to existing lawsuits, you want to think about possible lawsuits because anything that is going to impact the price of that stock after you close that offering, you want to make sure that we've made adequate provision in the book, in the registration statement, that tells people that there may be a material danger here, that we have another lawsuit crop up. You also want to talk about possible acquisitions, divestitures, restructurings, and management changes that may occur in connection with or after the IPO for the same reasons. Anything that is likely to impact the value of the company in a material way, we want to make sure that we're addressing that with disclosure in the book. Next slide. So the next thing we'll talk about is the quiet period. Now that generally begins at the time when you hold your organizational meeting at the beginning of this process or when you select your lead underwriters. And that period is going to last until 25 days after the offering date, right? There are a number of prohibitions on what you can say publicly, but generally you want to avoid public communications having the intent or effect of promoting the company or arousing public interest in the company or its securities. There are a number of safe harbors. For instance, ordinary course business communications can continue, but you need to make sure that you check with your underwriters and your legal counsel before issuing any press releases or public announcements while you're in the quiet period. Next thing we're going to talk about is the Jumpstart Our Business Startups Act, or the JOBS Act, which created a new category called an emerging growth company. And an emerging growth company is any issuer that had total gross revenues of less than $1 billion during its most recently completed fiscal year. Generally, EGCs have up to 5 years following an IPO to come into full compliance with certain disclosure regulations and accounting and auditing standards that other public companies are subject to. So basically the government gave us a break. If you're a smaller company, they made it easier on you to get through the window to go public. Next slide. Some of the reduced financial statement and other disclosure requirements that you enjoy as an emerging growth company is that you're only required to provide audited financial statements for 2 years. Likewise, your separate financial statements of acquired businesses are also limited to 2 years. And I wanted to stop for a minute and talk to you a little bit about some pre-IPO planning that we want to make sure that people do. If you do an M&A transaction in anticipation of an IPO or shortly before taking your company public, you want to make sure that your lawyers in that M&A transaction include provisions in those documents that allow you to go back to your seller and acquire additional information that may be required for you guys to go public. That could be financial information, other work papers, those sorts of things. If you don't have a contractual right to go back and seek that information and get that from your seller, we've often seen companies delayed or derailed or otherwise frustrated by their inability to provide the required financial statement or other disclosure because they didn't have the right to go back and get that information from their prior seller. In addition, EGC's selected financial data is not required for any period prior to the earliest audited period. Same thing for MD&A. It only covers the fiscal periods presented, and you're not required to obtain audits of their internal control over financial reporting. The Jobs Act also allows an EGC to get out of providing compensation disclosure and analysis, and instead allows for scaled executive compensation disclosure with respect to your executives. That reduces a lot of drafting, a lot of thought, a lot of lawyer time, a lot of consultant time, so that's certainly a benefit to an EGC. Another benefit that the EGC has with respect to the conduct of their offerings is they get to what's called test the waters before and after the filing of a registration statement. Irrespective of the quiet period, an EGC and their representatives can talk with qualified institutional buyers and institutional accredited investors to gauge their interest in the offering, which is certainly a benefit. Research analysts also have a greater ability to communicate with investors and with the EGC's management, and underwriters have more flexibility to publish research. A great thing about being an EGC is that you also get to file a confidential Form S-1. Previously, if you wanted to go public and you filed your registration statement, you had to put it out there for all the world to see from the get-go. Now, as an EGC, you can confidentially submit a substantially complete Form S-1 with the SEC without it being publicly available. You can go into the review and comment period, which is the same as it's always been, but you get to do that confidentially. Now, one thing to note is that the S-1 and any amendments must be publicly filed on EDGAR not later than 21 days before the roadshow. The next slide is just kind of an overall timeline. As you can see, your first 8 weeks, give or take, are going to be spent from the org meeting, doing due diligence, developing your financial model, drafting the S-1, and filing it. At that point, you have a decision to make whether you go public or you go confidentially into the SEC. And that process is the same through the review and comment period, and that's going to take you approximately 8 to 12 weeks, sometimes faster. Once you get through SEC comments, you're going to print your book, launch your roadshow, price it, and close, and that's approximately 4 weeks, give or take. The next thing I want to talk to you about today is board governance. As a private company, you probably have more lax governance practices than most public companies, and so what you need to be aware of is that there is a significant amount of governance that goes along with being a public company. For instance, the majority of your board must be independent within 1 year. And you'd probably want to target having 5 independent directors because you're going to have 3 different committees at least. And to share that burden of serving on the committees, you want to have a sufficient number of directors. And those independence determinations are both quantitative and qualitative and set out by the SEC and the stock exchange rules. Your lawyers can help you work through all of those requirements in selecting the appropriate people to serve as your independent directors. As a public company, you probably want to have your directors enter into indemnification agreements where they have a contractual right to be indemnified by the company in addition to any indemnification that is provided in the articles and bylaws of the company. And you want to kind of retool your D&O insurance to be more appropriate for a public company. Now, like I said, there are 3 committees that you're generally going to have when you become a public company: the Audit Committee, the Comp Committee, and the Nominating and Governance Committee. The Audit Committee is essentially in charge of being responsible for the financial statements of the company. It's comprised of 3 independent directors that can be phased in over a period of time. There are additional independent standards that apply to Audit Committee members, and you must have at least 1 Audit Committee financial expert. And you should talk to your lawyer about exactly what those independent standards are and how to qualify as a financial expert. The next committee is the Compensation Committee, whose key role is to determine compensation for the CEO and other senior executives. The Dodd-Frank Act also imposed additional independence requirements for Compensation Committee members and requires committees to consider specific independence factors for their advisors. Last committee is the Nominating and Corporate Governance Committee, which basically takes a lead in identifying director candidates and recommending overall governance policies for the company. Many times the lead or presiding director chairs this committee. But as you can see, there are a number of different governance items that you're going to have to address prior to going public, and we've only scratched the surface here. The last thing I want to talk about is the corporate and capital structure of your company before you go public. First thing you want to do is evaluate your current structure and discuss any restructuring needs. Rarely do we find a company that doesn't need a little bit of restructuring. And so that's going to include a lot of thought from the tax folks and accounting and legal. But nonetheless, everyone needs a little bit of restructuring, or you want to identify those issues early so that you don't start down the wrong path and have to retool. Once again, like I discussed earlier, you want to make sure you've got enough authorized shares for a public company. You're going to want to talk to your lawyers about amending your bylaws and your charter to be in a more public company form. Each of your issuers' counsel should be able to provide you with one that is appropriate for a public company. Some of the things that we like to, odd things that we like to hit on is a business opportunities waiver. For instance, if you've got private equity backing your company and you're taking them public, and that private equity fund is going to have somebody sitting on your board, they are necessarily going to run across business opportunities that may be appropriate for the public company. However, you want to make sure that that public company has waived those business opportunities so your private equity director doesn't find himself facing a breach of fiduciary duty claim or something like that. Other things to consider, including in your charter and bylaws, are exclusive forum provisions. You should talk to your lawyers about the advisability and enforceability of those, and takeover defenses. And those can include something as simple as a classified board, something as complicated as a poison pill. But you're going to want to talk to your lawyers, you're going to want to talk to your underwriters about all of that to make sure that it doesn't impact the marketability of your offering. And so with that, I think I am done. That is a lot of information in a short period of time. We'll have time for questions at the end, but for now I'm going to turn it over to Lori and let her do tax.
All right, thanks, Wes. Now we'll turn to the tax side, and we'll discuss some tax aspects of pre-IPO planning that can help lead to a greater IPO success. Throughout my presentation, you'll note kind of two overriding themes. The first is the notion of due diligence that needs to occur prior to the IPO, and secondly, the importance of time, to give yourself enough time to implement changes or address any issues. You can see the agenda on your screen. We'll discuss the taxes and tax processes involved in presenting income taxes in your financial statements, your tax structure and changes in that structure that may need to be made in advance of or possibly coinciding with the IPO, and then sell-side due diligence, as I mentioned, and we'll briefly discuss some other items that you may want to consider from a tax perspective. So moving on to the first topic, your financial statements. You'll want to begin this process by evaluating your tax personnel and processes and coming up with a plan for going forward. You need to look at who's been preparing your computations under ASC 740, if anyone, considering that pre-IPO many companies are in a flow-through structure, so you may not have recorded income taxes in the past. Things to consider are whether or not you have the resources internally or you want to consider hiring internally, or whether or not you should consider engaging a third party for this part of the process. Also consider whether or not your audit firm has been independent with regard to the tax provision in the past, or at least for the periods to be presented in the S1, because if not, you may have to either consider or you will have to consider preparing those provisions again internally, or possibly engaging a third party to help you out, because, and I'm sure you'll hear this in Joe's presentation as well, your independent audit firm cannot prepare your income tax provision. Then you want to assess your internal controls and processes for meeting the reporting requirements as a public company. Private companies often or generally only prepare their provision once a year. Public companies are required to do that quarterly in a time and very resource-intensive process. So begin to plan for that and get those processes or personnel in place well in advance of the IPO. Then you want to look at the tax aspects of your financial statements. First, identify if you have any uncertain tax positions that may exist, those not more likely than not to be sustained if challenged by a taxing authority, and that's generally defined as 50%, and then address and document the impact. Again, we're talking about this notion of due diligence, and we'll cover that in a few more slides. And possibly consider, if you identify any compliance failures, you may want to consider resolving those prior to the IPO filing. Then assess your deferred tax assets and liabilities. As I mentioned briefly, you may not have ever recorded deferred tax assets and liabilities in the past if you were in a flow-through structure. So you'll have to consider quantifying those upon a possible incorporation with the IPO. You'll also want to, if you have recorded in the past, prove out the accuracy of what you do have recorded in your deferred balances by comparing those to tax returns that were filed and reconciling any differences. You'll want to prove your NOL and credit carry forwards to tax returns and evaluate any possible limits on usage that may result from the IPO. We'll get into that in a little bit more detail on a later slide, when you do potentially have a limit on those NOLs. And then finally, ensure that your deferred tax assets meet the more likely than not criteria to be recognized. If not, you may need to consider a valuation allowance. And with that, I think it's our first polling question. So as a public company, can your external audit firm prepare your tax provision pursuant to ASC 740? Yes, no, or don't know. And while we're waiting on the responses to the question, one additional comment when it comes to valuation allowances. This continues to be an area of focus for the SEC as we've seen in various correspondence, including recent comment letters. They're continuing to focus on areas that require significant management judgment, which does include valuation allowances. So you want to ensure that your documentation in this area isn't boilerplate and that it provides insight into your own company's facts and circumstances. So I think we have the results, and yes, that is correct. You cannot have your independent audit firm prepare your provision. So talking a little bit about the structure, and Wes did mention this during his slides as well, you want to look at your structure and possibly simplify if you have an overly complex structure. In general, simpler is better. You can see two structures that we've put up there, the before and the after. In the before structure, you have P, a corporation that owns 100% of R, a disregarded entity, that then in turn owns a percentage of T, a partnership. P also owns 95% of S, another corporation, which in turn owns the remaining shares of T. In this case, you can see that there are minority shareholders in S. In the after structure, the minority shareholders have been eliminated, as well as that partnership structure below, which kind of resembles the old Texas LP planning structure. So, to many of us on the webcast, the before structure wasn't overly complex, but to investors, the after option is generally more attractive and easier to explain on a roadshow. But before you begin any restructuring, you want to make sure you talk to your tax advisors. As Wes said, you want to make sure you're going down the right path and you've run all the traps on what will happen when you do restructure. Many of the transactions involved can be done tax-free, but like I said, you want to run those tax traps. We touched on this earlier, but many closely held businesses are operated as flow-through entities for tax and structured as either LLCs, taxed as partnerships, or possibly S corporations. So either prior to going public or as part of the IPO, they typically convert to C corporations in the majority of cases. There is the possibility that as part of those transactions, you could end up with some immediate tax consequences, so you do want to talk with your tax advisor. So if you're currently organized as an S corporation, an IPO will terminate the S status. You can see your S corp year will end on the day prior The C Corp year will begin with the day of the IPO. In this situation, your tax accounting methods generally carry over, but keep in mind that there are the limitations on the use of the cash method by C corporations. So with the IPO, you may be required to convert to an accrual basis. Another consideration which may or may not come up is, your accumulated adjustments account, your AAA account for S Corp. That must generally, if positive, be distributed within 12 months of the termination of your S status. And it goes to all shareholders at the time it is declared. So if you do it post-IPO, then all of the shareholders who came in with the IPO are entitled to a share. So you may want to consider doing that prior to the IPO. With regard to LLCs, it's generally fairly easy to incorporate an LLC. So with a 351 transaction, in this situation, accounting methods don't carry over. You elect new accounting methods with the exception of your tax basis in your tax assets that may have been contributed. So moving on to this notion of due diligence, this is merely an internal review to clean up any issues and determine your status with the taxing authorities. As we discussed with determining your uncertain tax positions, you need to identify the issues and determine how to address and document them. So in general, you want to give yourself plenty of time to go through this process. It goes beyond income taxes. Uncertain tax positions deal primarily with how income taxes are defined in the financial statements, but you can see on the screen that we're talking about every tax type. You need to go through this process and consider whether or not you've been compliant in these areas. You may have to consider recording contingent liabilities for non-income taxes under ASC 450, which I believe is the codification for the old FAS 5. So once you've looked through everything, what do you do if you have identified compliance failures, maybe tax returns that were not filed, possibly states you determined you had nexus in that you haven't filed? Before you run out and file delinquent tax returns, there are other potential programs to become compliant, so you want to look at those first, possibly closing your compliance agreements with the IRS or state voluntary disclosure agreements, because there is the possibility that there's a reduced penalty framework and you can restore your compliance history, possibly without having to file all of those tax returns. You'll also want to consider penalty abatement requests, and finally, if nothing else, potentially filing delinquent returns as necessary to cure the compliance failure. Next, look at your open IRS, state, or foreign exams. What's the timeline to completion on those? Should you look at accelerating the completion of those prior to the IPO? Keep in mind that if there is a federal adjustment on an exam, that you have a requirement to amend your state returns, so you may want to consider that as well, in looking at the time to complete this. Look at any audit vulnerabilities you may have or issues of interest to tax authorities. This is generally the same process that you go through with your uncertain tax positions discussed earlier. I think that brings us to our next polling question. So if you fail to remit certain FICA taxes on employee restricted shares that had vested, you should consider a negotiated closing agreement with the IRS prior to the IPO, true or false. And while we're waiting on that, a couple of additional points I wanted to make in this area. Note that, again, this process will require coordination among a number of departments, possibly payroll for payroll taxes, AP on your sales and use taxes. So that fact alone will require that you begin the process as quickly as possible in advance of the IPO, or consider hiring a third party to come in and do some sell-side due diligence. Additionally, make sure you retain any documentation that you do gather during this process to support post-IPO examinations should they occur, as well as support for any positions, uncertain tax positions, or potential contingent liabilities you have to record in your financial statements. So the results are on your screen. That is true. You should consider entering into a negotiated closing agreement with the IRS prior to the IPO. And finally, just some other considerations from the tax side on going public. Now, some of these are very complex areas, so obviously we don't have enough time to get into them, in any great detail. But in general, we mentioned NOLs and credits could become limited if there's an ownership change upon the IPO. Ownership change is a technical term defined by the Internal Revenue Code under 382. It's generally, however, defined as a change in ownership during a 3-year period of greater than 50%. This could result in a limitation on the amount of pre-IPO NOLs that can be used in future years. So plan in advance if you're expecting a significant limit on those pre-IPO NOLs. Talk to your tax advisors in advance and see what you can do to potentially utilize some of those NOLs before the IPO. Next, a consideration are quantifying your earnings and profits, or your accumulated earnings and profits. Post-IPO, if there is a possibility that you would issue dividends, the company does have an obligation to provide shareholders with information as to whether or not it's a taxable dividend or a return of capital. Distributions are dividends to the extent of current E&P and then accumulated E&P. So that being said, consider performing an E&P study prior to the IPO to get your pre-IPO periods out of the way. That way it can be rolled forward to a point when you may issue dividends in the future. And finally, just a couple of comments on some management incentives, some areas you have to look at that could generate some non-deductible compensation to the corporation, which obviously impacts as a permanent item your provisions. We'll just hit on the high points again because an in-depth discussion is beyond the scope of this webcast. But 162M is a limitation on the deduction for compensation paid to certain named executives. It's limited to $1 million per executive, and there are exclusions for qualified performance-based comp. Further, there's a transition period as a public company before you become subject to these rules. So you want to pay attention to that. Additionally, public companies often consider negotiating golden parachutes with key management, which provides for financial compensation in the event of a change in control. Generally, this compensation could be non-deductible as well, so keep that in mind for the future. So to wrap up, our tax discussion, again, we hit on everything at a very high level, but if your vision for future growth includes going public, definitely start acting like a public company well in advance of entering the capital markets so you're ready. With that, I'll be happy to take questions as well during the Q&A session, but I'll turn it over to Joe.
Thanks, Lori. So what I have on my agenda to talk to you about this morning is the additional things that you'll have to think about disclosing to the readers of your S-1 or the registration statement in IPO. And really the 4 main areas, talk about the SK-1200 disclosures, which are the items that you have to talk about related to your oil and gas operations and reserves outside of the financial statements. We'll hit on some items that are important for management's discussion and analysis, and we will talk about things that have to be expanded in your financial statement disclosures and wrap up with some auditor independence and related issues to think about when you're considering an IPO. So SK-1200, I could probably spend an entire day talking to you about what goes in there, but I'll hit some of these at a high level. The disclosures required by SK-1200 go up in item 1 and really primarily the description of property section in the forepart of the S-1. There's the tabular disclosure required for reserve information, and that's going to be disaggregated by oil, natural gas, and natural gas liquids, and then if you have other products that are anticipated to be upgraded to oil or natural gas, those have to be disclosed as well. A discussion of the internal controls used in the reserves estimation effort, and this is an area of frequent SEC comment. Some places that can trip companies up when they're putting this together. The SEC expects you to talk about the people that are actually participating in the reserves estimation effort, including the person at the company who's primarily responsible for the review and approval of the reserves estimates, and if the company uses a third party to prepare or audit its reserves, the person at that third party and their qualifications and pedigrees for preparing those reserves. Another really important part is a discussion of the PUD reserves, and what they are looking for here is a narrative description of the material changes during the period. And in some of the SEC staff speeches, they've commented that they would really like a tabular presentation rolling forward your approved undeveloped reserves from one period to the next. And included in the narrative discussion, they'd like a discussion of the investments that the issuer has made and what progress has been achieved during the period to develop those PUDs, move them into PDP. They want to hear talk about why a company continues to report proved undeveloped reserves for more than 5 years from initial booking, and we could probably have a half-hour argument about what date is initial booking. But in any case, they do expect to see a discussion about why we would keep those reserves on for more than 5 years. Next is a tabular presentation of production, prices, and costs. And really what they're looking for here, they say production, but they're talking about sales volumes, and that becomes really important to distinguish when you have significant natural gas operations and you may consume some of that natural gas produced in the production and marketing efforts. And then prices and costs. Prices are fairly self-explanatory. The costs, what they want to see is lifting costs, so your lease operating expense excluding both severance and ad valorem tax, and all that on a per unit basis. A description of the net productive and dry exploratory and development wells completed during the year. And that's become an interesting point over the last couple of years, with several issuers having drilled wells but not completed them. And so the important factor to consider in compiling that disclosure is whether the well was completed, not necessarily whether it was spud. And then a discussion of present activities. Really that means what you've done since the last fiscal year end period, including wells that you've started, improved production activities, artificial lift, discussion of all that kind of thing. Then delivery commitments. For instance, if you have a minimum quantity to deliver to a natural gas gathering system, for instance, they want a discussion of the reserves that you have to satisfy those commitments and how you expect to satisfy those over time, and then a discussion if you have ever failed to meet one of those commitments. A table showing all the wells, gross and net, and ownership, and then a discussion of the gross and net undeveloped acreage. And like I said, we could spend a lot more time going into the details on these, and I'd be happy to field specific questions later on. But in any case, this was a review of what's required under SK 1200. On to MD&A. And really the three most important aspects of MD&A are a discussion of the results of operations, the company's liquidity and capital resources, and a discussion of the critical accounting policies. And I think this is an area that gets a lot of attention from the SEC, and they talk about it in speeches pretty frequently. And what they expect here is for management to seize this opportunity to really communicate with the readers of this information. With respect to results of operations, what happened? How did things go? What does management see for the future? Forward-looking information is very helpful here. And with respect to critical accounting policies, they're specifically not looking for a rehash of your footnote 1 basis of presentation and significant accounting policies. They're wanting you to discuss sensitive estimates, really critical things. What could happen if an input to a significant estimate changes, and how those might affect the company's financial position, results of operations, and/or cash flows. On to expanded financial statement disclosures, and this is really only a small list. There are other things that a public company must do that a private company doesn't have to. But I think these four are the most important and probably the most difficult. But earnings per share, private companies don't have to do that. Lori had a discussion of the expanded income tax disclosures, but for instance, private companies don't have to include a rate reconciliation. They just have to have a narrative discussion of why their effective income tax rate might differ from the statutory rate. A public company needs to actually show a tabular presentation and reconcile the effective rate to the statutory rate. And then unaudited, condensed pro forma information on significant acquisitions. And this is an abbreviated table that goes within the footnotes, but we talked a little bit about in Wes's section what happens when you've done an acquisition or there's one probable very close in time to the point where you're doing your IPO. Polling question. All registration statements must contain at least 3 years of audited financial statements. Getting some good responses here, so I'll show the results. This one's kind of confusing, and you have to kind of go back to Wes's presentation when he talked about emerging growth companies. But there are situations where you only have to have 2 years of audited financial statements. So the answer to that question is false. Thank you for responding. So on to some of the expanded financial statement disclosures that are required by ASC 932. Disclosure of capitalized costs related to oil and gas producing activities. And if your business is only oil and gas exploration and production, you may achieve this disclosure on the face of your balance sheet. Then results of oil and gas operations. This is a summary of revenues and operating expenses, depletion, no G&A, and the impact of income taxes at the expected statutory rate. Here's another example. If your business is substantially only oil and gas operations, you can achieve this disclosure on the face of your income statement. By the way, all of these items go in an unaudited footnote, usually towards the back of the footnotes. Tabular presentation of costs incurred, so costs incurred in acquisition, development, and exploration activities. Then a roll forward of total proved reserves for each year for which an income statement is presented. So that one's key because it's interesting when you think you have 2 years of financial data to present, that really means you need to have 3 years of reserve information, one starting point, and then 2 years ended. A disclosure of the proved developed reserves, and then a narrative explanation of significant changes in reserves. And I think that narrative explanation of significant changes in reserves is a frequent area of SEC comment. They want an explanation of why did you have extensions and discoveries? What acquisitions resulted in the purchase of minerals in place? And then a really good discussion of revisions of previous estimates. And most of the time there's pricing considerations to communicate there, but there can also be performance, and some of those can be up and some of them can be down. But they do expect an explanation sufficient to allow a reader to understand what went on there. Here's another area that we could probably have a day or two of discussion, but standardized measure of oil and gas reserves, and then a roll forward of those measures for each period for which an income statement is required. And standardized measure of oil and gas reserves, to really sum it up in a short manner, I would tell you it is the reserve report, PV10, and then adjust it for future income taxes. Complicated calculation, but it can be fun also included in the unaudited section of the financial statements. Let's talk a little bit about auditor independence, because if you were rocking along as a private company, under AICPA standards, independent standards, auditors are allowed to be a little bit more helpful than they are under SEC and PCAOB provisions. And so in thinking about what happens when you start to go public, one of the things to consider is how are the auditors going to convert their audit opinions conducted under generally accepted auditing standards into a PCAOB compliant audit. And some of that is really how the auditor is required to communicate with those charged with corporate governance. So there'll be a great deal of correspondence exchanged between your boards and management and the auditors. But the auditors also have to think about what non-attest services have they provided in the periods where we weren't considering going public. And this can trip us up, because here's a couple of things that can preclude the auditor from concluding that they are independent for all periods presented. If the auditor prepared or assisted in the preparation of the financial statements, they cannot be independent. And I think this comes as a shock in a lot of cases, because that assistance in preparation of the financial statements can take many forms. If the auditor types a footnote or types language for you to put in the footnotes, or if the auditor took your financial statements and printed them for you, bound them for you, sent them to you, that can be construed as assistance in preparation of financial statements and would preclude the auditor from being independent. Then income tax provisions, frequent area of auditor assistance to a private company. Preparation of an income tax provision would constitute preparation of the financial statements and would preclude the auditor from being independent. And there are some other non-attest services to be considered, but the point is to be really careful and have discussions early on with your auditor and figure out where are the things that are problematic and what do we have to do. So another thing, when an auditor considers whether they are independent under SEC and PCAOB standards, the auditor has to consider the impact of non-attest services that are provided to the affiliates of the issuer. And this can come into play when, as an example, if you're a private company and you have a private equity backer, and the auditor provides non-attest services to other portfolio companies of that private equity group, sometimes those can have an impact on what the auditor can conclude about their independence with respect to the issuer and the IPO. Partner rotation issues is a new thing that becomes applicable to a public company upon an IPO. And you might have heard about this referred to as burning a year or burning 2 years. But a partner can only serve as an engagement partner or an engagement quality reviewer for 5 years to an issuer, and then they have to rotate off for 5 years. So if the audit firm had been engaged to do the audit of the private company prior to the filing of the IPO, and that was a continuous engagement, then filing that IPO would result in the number of years of financial statements included in the registration statement elapsing. So for instance, if you're an emerging growth company and you have an IPO registration statement that includes financial statements for 2015 and 2014, then 2 years of auditor independence would elapse. So Wes touched a little bit on this, but significant acquisitions, it's really important to make sure that the seller of an entity that you buy contemplating an IPO will cooperate in getting the financial statements prepared and the other disclosures that are required to go into the IPO. And I see we're running a little bit short on time, so I'll skip ahead, but I'll be glad to take questions in the Q&A session, or we can exchange contact information and talk more after. Comfort letters, just be aware that that's an area that needs to be planned. An underwritten offering Usually the underwriters will ask the auditors to prepare a comfort letter, and what that really is the underwriters more or less delegating their due diligence responsibilities to the areas of the document that are outside of the audited financial statements back to the auditor. So I think that gives us to our final polling question. Auditors are allowed to assist issuers with the preparation of the financial statements. Hopefully this point rang true. And looking at the responses so far, it did. The answer to that is false. Auditors may not participate in the preparation of the financial statements for an issuer. I want to thank you for your attention, and I think now we will go to the Q&A session.
Thanks, Joe. We'd now like to give the attendees a chance to ask questions. If you have a question, please submit using the chat box on the bottom left corner of your screen. If we don't get to your question during the webinar, our presenters will follow up with you via email afterward. Okay, so our first question. You mentioned planning for utilization of NOLs in advance of an IPO if you were expecting a significant limit due to change in control. What are some ways that you can plan for utilization of NOLs?
Thanks, Carrie. One of the biggest ways to plan for that are possible method changes prior to the IPO that could result in you recognizing some income to offset those NOLs prior to the IPO. So that's kind of the first place I always start, is to take a look at your methods and see where you might have the opportunity to generate some income that way to offset those NOLs that you've created in the past.
Great. Thanks, Lori. Our next question, what is an average approximate cost to going public?
I'd love to start this one. The approximate range is from $0 to $25 million. All joking aside, consider that you've got several parties that are participating in the preparation of this document, and they'll all have to be paid. The auditors generally, I don't think that there's really a rule of thumb on how much an auditor might charge for an IPO, but consider that upgrading audits, reading the document, issuing the comfort letter, they can be very significant. The attorney's involvement, hours, very significant. That can be a huge cost. And then on top of that, you're typically paying somewhere between 5 and 7% of an underwriter's discount on the shares. So that goes into consideration as well. Wes, did you have something?
Yeah, I think there are a number of services out there that can provide you with kind of average numbers for that, but I think the latest that we typically have seen is it's about a $15 million proposition, depending on the size of your offering and whatnot, but kind of the average overall cost, including the underwriting discounts, is around $15 million.
Here's another good question I think you could handle, Wes. What are some of the reasons why an EGC issuer would not request confidential treatment of an S-1?
A lot of times what we have when we have companies going public are guys that are going dual track, right? So you will file your IPO, but you also are maintaining a potential sales process along the way. It's certainly a good marketing tool if you are marketing your company for sale, that you have a public company waiting in the wings. If the sales process doesn't go, it could certainly impact the value that you're able to obtain in an M&A transaction.
Okay, we have one final question we'll try to get through quickly here right before we end. What are the S-1 reporting requirements for a company that has not been in existence for 2 to 3 years?
You want to take that one or shall I? Okay. So it kind of depends. If the company had no operating assets and acquired them, or I guess I would revise the answer. It depends on whether there's a predecessor. So if there was a significant acquisition that resulted in the company being formed and that was within two years of the IPO period, you'd probably have to file some historical audited financial statements of the quote-unquote predecessor. And there's a lot of guidance around that. And if I didn't quite get to the question as you had intended, I'd love to follow up with you after this is over.
Well, thank you, Wes, Lori, and Joe. That's all the time we have for questions. Please check your inbox for a follow-up email with an evaluation form that must be submitted in order to receive your CPE certificate for the course. Thank you again for attending, and have a great day.